very much. It's a huge honor to be here, it's a huge privilege to be able to start, because there are so many important issues at play. By being the first speaker, I get to just pick the ones I want to talk about and avoid all the difficult questions and let the very distinguished speakers coming after me deal with those. I come here as an outsider. Let me start with one simple idea. During this period, when China is transitioning from the period of hypergrowth, very rapid growth, to hopefully a period of moderate but sustained growth, the usual rules of macroeconomic policy don't apply. The rules work differently. Why? Usually, we think that there is a certain target economic growth rate. If the growth rate falls below the target, then macro policy should become more expansionary. The monetary growth rate should be increased in order to pull up nominal GDP growth, in the hope that some of the increase in nominal GDP will be reflected in an increased real GDP growth. In other words, some versions of the Taylor rule to govern central bank behavior. But in the current conditions, this rule doesn't work. Why? Because the short-run decline in the growth rate is actually signaling a decline in the long-run sustainable growth rate. As China's growth rate drops over the last couple of years, it sends a powerful economic signal that the Chinese economy is tending to re-equilibrate on a slower, more sustainable, but still strong medium growth rate. All right? So let me start out by that. We want to not accept the normal rules of macroeconomic management. What's the principle here? I'll just tell you. Okay. So, and I think to see this, the best way to see it is to go back to the experience of Japan and Korea. And of course, there are many experts in Japan and Korea in the room. I'm just giving a very, very simple version. But I think in this simple version, we see four stylized facts. First, their economies begin to slow because of long-term structural changes. Changes that you all know about in the labor force, in the composition of the underlying real economy. The government, at first, in response to this tendency to slow, makes macroeconomic policy more expansionary. Monetary growth and fiscal, in most cases, fiscal deficits as well. But then there's a sudden shock from outside the economy. In the case of Japan in 1973, most obvious, the oil shock, right? And when that happens, fourth, growth drops very dramatically, and it never recovers back to the initial high growth level. So for instance, in the case of Japan in 1973, growth drops from 10.4% per year for 23 years down to below 6%, just like that, without ever retaining the previous heights. Now this pattern is a kind of a puzzle, right? Because the changes in overall growth potential are all gradual, but the actual experience is one of a sudden sharp drop from high growth to medium growth. Next slide. Now, I suggest, to simplify a great deal, that this pattern can be understood in light of two things. First of all, the slowdown in the economy begins with a decline in the rate of return to investment. Right? Lots of projects that made sense under the old growth model start to have a lower rate of return, and so private businesses start to invest less. For example, in the large N study of growth slowdowns that Barry Eichengreen did, what he shows is growth slowdown is not triggered by a sudden drop in investment. Instead, it's triggered by an unexplained drop in total factor productivity. There's something else happening that causes a response that drives investment. And so we would normally expect to see a decline in the rate of private investment But in fact, in the forerunner economies, and of course in China as well, we see an increase in government-stimulated investment that offsets this implicit decline. And then second, when we see the sudden discontinuous drop from high growth to medium growth, and we have this puzzle to explain, which is why is it so sudden, I suggest perhaps what we observe is in fact a short-run recession combined with a very slow recovery because of the impact of financial overhang, reduced assets, difficult financial structures to unwind. In other words, what happens when hypergrowth ends is kind of similar to what's happening in the United States economy right now. Namely, although the recovery is underway, the growth rate is extremely slow because of debt overhang, reduced value of assets, and other financial related problems. Next slide. So the simple rule for us is do not pursue overly expansive monetary and credit policy in the attempt to keep growth high. In other words, it's wrong, it would be wrong for Chinese policymakers to target the growth rate as the fundamental objective of economic policy right now. So when Premier Li Keqiang says, look, the growth rate this year may fall below 7.5%, it's not the central target, he's doing exactly the right thing, and that should be the basis for policy. This is what this tells us. Of course, this doesn't answer all the questions because we still have great issues about how far the growth rate should be allowed to drop. But what it tells us is the normal cost-benefit calculation about expansionary monetary policy should be quite different under these particular conditions. Usually, we weigh the immediate benefits of a monetary expansion against the long-run inflationary costs. But for China in this current stage, we would have to weigh the immediate benefits against not only the inflationary costs, which actually are not that significant right now, but more importantly, the long-run costs in terms of making the transition to a lower growth rate more difficult. Next slide. So, how does this framework fit China today? I think very well, right? China has been in a very expansionary policy mode ever since the global financial crisis, including the last 18 months when financial innovation is taken into consideration. The growth rate of credit has been quite high. And as a result, China has maintained what everyone knows is this astonishing investment rate, 48% of GDP 5 years in a row, absolutely unprecedented. And we can already see that the return to investment is beginning to fall across the board. Let's look at the simplest, the clumsiest, but also the easiest to understand, the most reliable indicator, which is the incremental capital output rate, or the I-core. China has had these superior I-cores of around 4 or 4.5 for a decade up until the global financial crisis. But that has now increased to about 6.4 systematically over the past 2 years, and certainly this year as well. That means to get an extra dollar of GDP, instead of investing $4, China now has to invest almost $6.50. Now, in and of itself, that's not bad, right? Many economies grow just fine with an incremental capital output ratio at about this. But what it tells us is, in many sectors, the rate of return to investment is declining, and investors will want to invest less. Next. In fact, we can see here, this is a graph I stole from the people at Standard Charter, which I think shows very nicely what's happening. The green line is nominal GDP growth, right? So real GDP growth plus inflation. And the blue line is total credit growth. And so you see very clearly, right, the long-term consistency of these two. The global financial crisis where growth drops, but a very powerful expansionary credit impulse is unleashed. The two are then brought together, but then in the last 2 years, again, growth is sliding. Credit growth at first increased, and this shows that Chinese policymakers, to a certain extent, are falling into this natural trap of trying to keep the growth rate from slipping by increasing the growth of credit. Next. So, of course, we also see at the same time evidence of financial stress. You all know this. I'll just tick it off. Housing, public infrastructure, and certain manufacturing sectors. We see excess capacity, signs that there are bad assets that will have to be written off, and financial liabilities that will have to be restructured. So in that sense, China differs from Japan and Korea in their earlier incarnation in that the financial elements of the crisis are already appearing at a relatively early stage of the growth slowdown. Typically, say in Korea, they happened after the growth slowdown. Next. And this is an additional argument against further stimulus, because further stimulus, more rapid growth of credit, will simply increase the flow of resources into precisely those sectors where excess capacity and underutilized assets are appearing. So we should hold on. Next slide, please. The additional factor here is that we're on the eve of a very dramatic realignment of the expectations of Chinese people and Chinese markets about what kind of investment, what kind of returns make sense. Consider the following characteristics of expectations today. Right? Young people in China have never experienced a recession. People think that housing is the best investment and really the only good investment. People think that financial investments are low return or else really risky and generally not very attractive. And people believe that the government will protect them from bad economic outcomes. These were all true looking backward. None of them are going to be true over the next 10 years. So there'll be a dramatic change in expectations. It's going to move markets in ways that are difficult to predict. Next. And therefore, it's important that policymakers keep policy weapons in reserve, ammunition in reserve. In other words, the final reason not to engage in stimulus now is because additional bursts of stimulus will almost certainly be necessary later on at later stages of the crisis. If China exhausts its weapons kit, it will be in a much worse position when further things happen. There are demographic reasons. I won't talk about that because other people will discuss it later today. Next. So I suggest, therefore, I think that slide is actually misstructured, so let's just go on to the next one. I suggest the following set of policy principles. Number one, policymakers should lean against the wind with respect to the investment rate. In other words, let the investment rate decline modestly as private actors, as businesses, dial down their investment in certain overheated sectors, like housing. But not let that decline in investment be too big. In other words, think of it in terms of 2 or 3 percentage points of GDP, which is to say to decline to about 5 or 6% real growth rate. And then let the rest of it happen. Next. Then, in addition to those policies, we need stronger policies that signal to the private sector that new opportunities are opening up in new sectors. We see the government doing this already, but I think this needs to be stepped up, because what we haven't seen yet is really strong messages from the top political leadership towards business leaders that their views are going to be more listened to, that they have more areas that they can go into, and that they'll be able to take control of more investment projects, not just participate in more investment projects, but take control of them. Because there's a potential here for the government, through reform, to generate a new set of positive expectations about the economy that will help greatly in overcoming this difficult transition period. Further financial liberalization policies are probably called for, including more use of credit cards. And there's a whole package of expansionary fiscal policies that should be prepared for use quickly. I propose a cut in Social Security contributions by Chinese workers, expansion of transfer payments, more public health expenditures. These are all areas where China, as a middle-class economy, should be doing more in the fiscal sense. And if the timing of this is right, it will help to buffer this transition to a new growth strategy. So finally, last slide, I basically just said that. Current policy is basically on track, but what we need to do is make sure that the government doesn't try to prevent the change in expectations that's underway, because that change in expectations, when it reaches a new equilibrium, can become the driver of a new sustainable medium growth path that can drive China to a new level of income and prosperity. Thank you.